Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday the 3rd of December 2019. And yesterday we produced two videos. Gold and silver prices fall, here's why. And magic money tree to the moon. Now the magic money tree is a prelude to a range of videos we shall be producing over the coming weeks, alerting you to some of the concerns the financial markets are now beginning to accept. Traders, analysts, and decision makers knew those concerns were there, but now they are slowly starting to acknowledge that they may gradually arise to the surface and become problematic. More on this in a future video. Today we're going to discuss the poor ISM figures announced yesterday and what it could mean for equities, the dollar, and gold and silver. Now, in our weekly gold and silver update published on Saturday, we pointed out that this week there is a substantial amount of US economic data being announced, culminating in the very important non-farm payrolls report on Friday. Now, in fact, our exact words were, quote, "So, we have a large amount of data and reports to digest next week, many of which have the potential to influence the dollar value and gold and silver prices." Now, yesterday, three important figures were released. The construction spending figures for October, which were down 0.8% against a forecast of up 0.4%, and worse than September's figures of minus 0.3%. The market manufacturing PMI for November at 52.6, marginally up from October's figure of 52.2%. But most importantly of all, the ISM manufacturing index for November declining from 48.3% in October to 48.1%, and against expectations of a rise to 49.2%. This shows that economic activity in the manufacturing sector contracted in November and was the fourth consecutive month of PMI contraction, and concerningly at a faster rate compared to the previous month. Now, despite this, the overall economy has still managed to grow for the 127th consecutive month. Now, the ISM report helped to put pressure on US yields and saw the dollar index fall by 0.06 to its current level of 97.78. Now, this served to buoy gold and silver prices a little, which, at the time of writing, which is 1100 hours GMT, gold stands at $1,469 and silver $1,703, breaking that, once again, important $17 mark. Now, on its own, these figures are not going to affect markets considerably, though we have seen the Dow Jones close yesterday down 268 points, and the S&P closed down 27 points, though much of this is also to do with the deepening concern of a US-China trade deal not happening and other comments made by President Trump. Silver prices, now up on their Monday's opening, are showing some resilience despite an initial fall. And quite frankly, there is a schizophrenia amongst traders about this market. Whenever there is bad or poor economic news, they keep having to calibrate the reduction in potential industrial demand for silver that is likely to ensue and assess it against the potential in investment demand for it as a safe haven asset. And there is no magic formula that can predict this accurately, as to a large extent one is dealing with sentiment, emotion, greed, and fear, which is always difficult to measure in advance. Now, that said, there is an interesting report published by Reuters this morning, which could give gold and silver bulls a little hope. We shall now read that article. Reuters article dated December the 3rd, 2019, 8:50 a.m. Daily briefing. Trade sabers rattling again. London Reuters. The market assumption of trade peace has been premature at best. World markets skirting record highs over recent weeks had priced to assume an imminent truce in the US-China trade war that would underline a fourth quarter trough in global industrial sentiment. Monday threw a curveball into that consensus. As he departed for this week's NATO summit near London, US President Donald Trump unexpectedly reignited world trade tensions by announcing tariffs on US steel and aluminium imports from Brazil and Argentina, citing massive devaluations of their currencies that have hit US farmers. Alongside simmering anger in Beijing over Washington's support for Hong Kong's pro-democracy street protesters, the sudden bellicose trade action raised concerns of another wave of protectionism from the Trump administration as the December 15 deadline for new tariffs on Chinese goods looms without any formal agreement between the two sides yet inked. China on Monday banned US military ships and aircraft from visiting Hong Kong and slapped sanctions on several US non-government organizations for allegedly encouraging anti-government protesters in the city to commit violent acts. In one of the understatements of the past week, Trump said the Hong Kong law did not help the trade talks. And adding to fresh heat in global trade relations, the World Trade Organization on Monday rejected European Union claims that it no longer provides subsidies to plane maker Airbus, prompting the United States to say it could increase retaliatory tariffs on a wider range of European goods. The US government then added it may slap punitive duties of up to 100% on $2.4 billion in imports from France of champagne, handbags, cheese and other products, after concluding that France's new digital services tax would harm US companies. French Prime Minister Bruno Le Maire countered on Tuesday and said the latest US tariff threats on French products were unacceptable and the European Union was ready to issue a riposte. Reminding everyone of just how fragile the wider troughing of global business sentiment still is, data from the US Institute for Supply Management said on Monday that factory activity contracted for a fourth straight month in November as new orders slumped back to around their lowest levels since 2012, while construction spending fell in October, tempering recent optimism over the world's largest economy. The net effect to the ropey start of the week was to knock stock markets back across the world, with Wall Street's S&P 500 almost losing 1% in its biggest one-day drop in almost 2 months. The VIX equity market volatility gauge surged briefly back above 15% for the first time since October. The US dollar plunged in response to Trump's latest exchange rate sensitivity, fresh pressure on the Federal Reserve for more interest rate cuts, and the ISM shock. Its DXY index against other major developed world currencies staged its biggest one-day loss since early September. The trade angst rang around Asia bourses overnight. Tokyo, Hong Kong, Seoul stocks all ended in the red for the second day, even though Shanghai managed to outperform and clung onto positive territory. After their worst day in 2 months on Monday, European stocks stabilised at the open. Elsewhere, the Australian dollar rose 0.34% after the Reserve Bank of Australia left rates at a record low of 0.75% on Tuesday at its last meeting of the year. On the European corporate news front, the US tariff threat on French products such as champagne or handbags hit the stocks of companies such as LVMH, Kering, Hermes and L'Oreal. European stocks could also suffer as a whole after the US threat of retaliatory tariffs following the World Trade Organization ruling on Airbus. End of article. So, equities are in a potential pickle, especially since the president is now threatening even more trade tariffs and the China-US Phase 1 trade deal may not actually happen by the 15th of December, as many had hoped. Will this be a repeat of what happened to equities in December 2018? We don't think so, as the Fed is not on this occasion going to raise rates. That said, equities may dip from their all-time highs unless there is some positive economic news to bolster them. There is still much data to be revealed this week, which could also have an effect, especially from Wednesday onwards. Meanwhile, today we have motor vehicle sales for November to be announced, and whilst this is unlikely to be earth-shattering, they may prove yet another guide as to where the economy is heading. There is still in the back of our minds the thought, and we could be entirely wrong here, but a conspiracy theory we will throw out there is that the president is deliberately creating this chaos and uncertainty in order to force the Fed to continue its interest rate reduction, so that come a closer proximity to the presidential elections next year, these reductions will have fed through to the economy, and also a trade deal will be announced, thereby lifting markets and improving the US GDP figures in time for the election. Now this could be far-fetched, we admit it, as it would be a most risky strategy to adopt, especially as equity markets could tank in the meantime. Whatever happens, though, the Trump administration has a degree of control or influence, and so much of its fate therefore lies in its own hands. Meanwhile, we earnestly suggest that you watch gold and silver prices this week, because as we predicted in the weekly update, and details of all the videos we've mentioned we list below, we are expecting some volatility. Thank you so much for listening. If you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of videos as and when they are published. And finally, just a reminder that we've produced 3 important videos in the past couple of days concerning $100 silver and is there a silver supply squeeze developing. And again, we have listed these in the description box below. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.